Hello everyone, welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. I'll be covering this week's slide for you. This week's chart shows how the S&P 500 market share of each year's top 10 stocks evolves over the following 5 years. So effectively what we're saying is who are the top 10 stocks in the S&P 500 as far as size, and then what percentage of the S&P 500 do they make up? People get confused of how the S&P 500 works. If I were to invest $500 in the S&P 500, I would own 500 stocks, but I wouldn't own $1 in each of those stocks. I would own those positions based upon their market capitalization, or market cap for short. So in this scenario in 1999, if I invested $500 in the S&P 500, I would have about $125 of that in the top 10 stocks. Now this year we're up to over almost 36%, which means we're approaching $180 to almost $200 of that $500 that's invested in the top 10 stocks. Now right now you're seeing a lot of press and media talking about what we refer to as the Magnificent Seven. See if I can do those off the top of my head. Facebook, Apple, Amazon, Nvidia, Tesla, Google, and I'm missing one, but anyway, but you get the idea. They're the top 7 stocks that are out there. We're looking at the top 10 as far as size here. So rather than call them the Magnificent 7, we'll call them the Magnificent 10. Having said that, historically, you can see railroads and plastics or cars or oil or landlines or the internet or even AI are new at any given time, but innovations that spur secular investment cycles are not. So they don't always do well. What's interesting, the last 4 or 5 years, we've kind of been in a little bit of a bubble here where these companies are actually doing well. These top 10 companies do well, but we know historically that's not going to happen. Entropy is inevitable. They're going to eventually not have the growth that they want. A lot of things can happen with that. It could be change in technology. It could be breaking up of a monopoly. It could be just bad management. There's a lot of different things that happen. But you can see on average the top 10 share from 21% initially to about 14% by year 5 and 10% by year 10. That's on average. And so you can kind of see over the long run these companies generally get eaten up by other things. What's interesting right now is some of these companies right now are doing very, very well, and they're continuing to gain market share because of where they're moving with good management and looking at AI and other ways that they can grow and develop, etc. So currently we're seeing at about a 50-year high on these with these top, these largest companies having up to 36% of the market share of the S&P 500. Having said that as we look at this, how do we look at going forward? What do we do to make sure that in the future we don't make the mistakes that happened in the past? The key is to have a diversified portfolio and make sure that not only do these growth companies make up a portion of your portfolio, but you're also able to warrant any uncertain issues in the future, whether that be market crashes or what we refer to as black swan events. And so we want to make sure that the diversification is there. We want to take advantage of these cycles that happen, but at the same time we also don't want to try to pick or choose and try to predict market outcomes based on that. And so right now we're looking at PE ratios. The PE ratios right now in the tech sector is about 30 times, 30x. What that effectively means is for every dollar of profit, you have to invest $30 into the stock. Now at the peak of the tech bubble in 2000, that got as high as 70x or 70 times. And so we're still not in this bubble. We don't have a bubble situation creating, but it doesn't mean that we don't have any market volatility coming forward. So I think a healthy dose of wariness about high concentration and elevated valuations is always warranted. So we want to make sure we're careful on that. So anyway, hope that makes sense. If you have any questions, feel free to reach out to our office. We're looking forward to meeting with you and answering any questions that you have. We're always available. Look forward to having our next round of reviews over the next 6-8 months. And if you have any questions in the meantime, please call us. If you have anybody you'd like to share this information with, feel free to forward them the link. And we appreciate your business, and we look forward to seeing you soon. Thanks.